And I love my favourite phrase by Minsky is stability is destabilising. We're not alone in doing that, unfortunately. Now, to argue that private debt plays a role would have Paul Krugman saying what a load of rubbish I'm speaking right now. Anybody see the debate I had so-called with Paul Krugman about 4 years ago? Okay. According to the mainstream, this is what Krugman says in his book, End This Depression Now, exclamation mark. When debt is rising, it's not the economy as a whole borrowing more money. So he's arguing there's no relationship between the level of debt in the economy, private debt, and the amount of money supply. They're independent from his point of view. And that is nonsense from a technical point of view. It's a childish economic theory game, a childish model that economists have. And for about 40 years there's been a non-orthodox group of economists saying that's not the truth about lending. Banks create money by lending. Loans create deposits, not the other way around. And it's been a minority position, but the Bank of England finally came out just 2 years ago and said that we're right, the minority is correct, the majority is quite wrong. When you look at the technical side of how banks operate, when a bank creates a loan, it creates deposits. Bank lendings create deposits, not the other way around. So the idea that banks just are intermediaries is wrong. They are loan originators, and that makes an enormous difference to the impact of credit on the economy. And when you correlate credit with unemployment, again, according to the mainstream, there should be no correlation. That's Ben Bernanke. You can look at page 24 of his essays on the Great Depression. There should be no significant relationship between debt and macroeconomic variables. That's correlation there over 40-something years of data is minus 0.88. I think that's significantly different from zero. Any disagreement? They continue ignoring this stuff. I've been publishing data like this for 10 years, and I still don't see any of them do any empirical research on it. Now, when you then look at the asset markets, of course, there was a huge bubble in household debt going from 3% of GDP to 9% of GDP, and then you can see the plunge that occurred there. Up goes the house price index until shortly after the peak of the private debt borrowing, and then it's fallen 70%, and then it's flatlined ever since for about the last 6 or 7 years, flatlining with that huge fall in house prices. Now what drives, and this is a slightly complicated argument, what drives house prices is the acceleration of mortgage debt. And I'm now going to define mortgage debt. The change in mortgage debt is mortgage credit. So when you think about the monetary demand for housing, it's fundamentally mortgage credit. You divide that by the price level, you've got a rough index of how many physical houses can be bought. You take the physical supply on the other side, you do a simple analysis of a price equilibrating between the two, and you find there's a relationship between the change in mortgage credit and the change in house prices. This is the Japanese data. That correlation over, what we got there, 55 years is 0.5. Now again, this is supposed to be zero according to the mainstream. And the economy, I call this little graph my smoking gun of credit, because what I do here is take GDP as the red line, add change in debt to it, which I know is empirically slightly wrong, but it's a reasonably accurate guide at the same time, with so much debt being created for asset purchases these days rather than goods and services. And the Japanese economy tanked when the credit level started to fall. Credit I'm graphing on the right-hand side here. This level of credit, which is change in private debt per year, is 27% of GDP. That was the peak level. It then plunged down to minus 15% in 2000, and for most of that period it's been negative. When you add the two together, GDP plus credit, you see that they haven't had the same level of nominal demand in Japan ever since the crisis. Now, before the crisis, the average level of credit for that decade, 1980 to 1990, was 15% of GDP. The average since then has been minus 0.5% of GDP. So what we're facing in Japan's case and also in America is not secular stagnation. That's a piece of jargon that Larry Summers has dragged out of the past and tried to explain what they can't explain. It's credit stagnation. Credit demand is a normal part of a well-functioning capitalist economy, but it's evaporated in all the countries that had these debt bubbles. We're one of the last ones to still be having credit demand, which is about to run out. So look at the United States now, using the same scale on the left-hand side. So America didn't reach the same peak level of private debt as Japan did, but same story. Government debt was falling with a couple of blips, courtesy of invading other parts of the world and bombing the hell out of them. But the rise in government debt began after the crisis hit, The crisis was caused by this level of debt peaking and then falling. Now looking at the change in debt, which again is credit, and graphing that against the unemployment rate, the correlation of credit to the unemployment level in America over 40 years, pretty much, 35 years, is minus 0.64, and you take the years from 1990, it's minus 0.93. So credit is the fundamentally dominant driver of economic activity in America. And again, looking at that house price story, you have a dramatic increase in house credit, mortgage credit, going from 3% of GDP at the bottom of the end of the 1990s recession up to about 10% of GDP, then plunging, then starting to rise again, and house prices have recovered a bit because they have risen. Look at that relationship of the change in mortgage credit to the change in house prices, and using Granger causality, which is a very inappropriate way to measure this causality. It's more likely to reject causality where it actually occurs because, like most econometric tests, the Granger causality is completely linear in its logic. This is a highly non-linear relationship, but the correlation between change in house prices in America and change in mortgage credit is 0.6 since 1976. It's higher again, of course, since 1990, after the bubble really took off. So what's driving house prices is accelerating mortgage debt everywhere else in the world except Australia, because we're different, aren't we? Well, we'll see that in a moment. Here's the smoking gun of credit for China, for America. And again, I'm graphing on the same scale on the left-hand side. The peak up here is 60% of GDP. Hong Kong actually got that high in 1 year. But America's peak level of credit was 15% of GDP when the crisis began, plunged to -5. It's now back about +7. Dream economists. What caused the crisis? They'll say it's an endogenous shock. Now, before the crisis, they were telling politicians that the current economic situation is better than we've experienced in years. Politicians who swallowed this OECD stuff in June of 2007 were expecting to take the credit in the forthcoming elections for the great state of the economy, because it exploded in their face after that event, which is a major reason why we're seeing a change in some of the central banks, particularly the Bank of England on that front. Now, even after the crisis began, the Federal Reserve's Open Monetary Committee was advised by its own modellers, and the modeller's advice to them in December was that even after all the financial turmoil, the economy avoids recession. Well, that was helpful. Now, 2008, it should be 2008 there rather than 2010. I'm quoting from the date of the book rather than the date of the conversation. But in 2008, there was total panic in the White House. I've actually spoken to Ed Lazaire, who was Bush's chief economic advisor, and he said literally that's the state of mind they were in. They felt that capitalism wasn't going to fail on their watch. They thought if they didn't do something drastic, the whole economy could collapse and they'd be blamed for it. And they weren't going to allow that to happen if they could possibly prevent it. So Paulson, when he was trying to persuade Congress to vote for the TARP program, was asked, what happens if you don't give you the money? And his answer was, may God help us all. That's the level of fear that existed at the time. They threw all their standard macroeconomic principles out the window, threw the kitchen sink at the economy and managed to stop it going down the gurgler. But after the event, the mainstream has attempted to explain the crisis, but all they can say is, well, there were bigger shocks. This is a paper from 2010, where a leading neoclassical economist in Ireland said that the recession was caused by a set of adverse preference and technology shocks. Do you feel any of those shocks go through yourselves? This is all they can generate a crisis for out of their model. Shocks to consumer taste and shocks to technology. And then he said the crisis occurred because the shocks got bigger and went on for longer. So it's all an exogenous explanation of where the crisis came from. And now, what Larry Summers is blaming for the crisis, I can paraphrase as saying we're having low growth now because parents are having less babies and engineers are having less ideas. Not the fault of the economists. Nothing to do with the financial sector. In writing just in 2014, he said if a financial crisis represents a kind of power failure, one would expect growth to accelerate after its resolution. So far as Summers is concerned, there's no financial crisis, no financial issues left in the economy. They're all in the past. So you need to explain what's happening now by slower population growth, slower technological change. Now, to drag that argument, have a conversation, these are the countries that have a debt ratio above 190% of GDP. And what I've done in this table is to look at what's going to be the impact of the debt level continuing to grow as it has, stabilising or the actual level of debt stabilising. So looking at Portugal, for example, its GDP last year was 195 billion. Last year its debt level was 377 billion, giving it a ratio of 193% of GDP. If its current growth rate continues, it'll fall because debt's actually falling in Portugal. So that gives you, I'm trying to get my mouse to activate here, that will give you a lower debt ratio next year. Now, that last year, the growth in demand in the Portuguese economy was 6.7%. If the ratio stabilises, it'll actually be higher at 16%. If the level stabilises, it'll still be higher at 9% because the debt level's falling. Looking at Australia, our GDP last year was $1.19 trillion US. Debt level, $2.46 trillion, ratio of 210% roughly. If the rate of growth continues, it'll be 217% roughly at the end of the year. Last year, in fact, the demand fell by 2%. When you add GDP to credit, of course I know there's some double counting going on there, you get a negative over the previous year. If the ratio stabilises at 208%, there'll be a 5% fall in total expenditure. If the level of debt stabilises, there'll be an 8% fall. So simply stabilising the debt ratio will cause a downturn. Those are the countries that I think are most fragile to this, but there are others. So I'll just take you through a couple of charts. So this is the overall, using the whole BIS database and applying the same analysis there, and I'll copy this to Teague. He can pass it around to you guys later. You can therefore read it. So those are the countries I see as vulnerable: China, Korea, Australia, Switzerland, Sweden, Belgium, Norway, Hong Kong. Hong Kong, I've got a question mark about, having just looked at the data more carefully for Barclays recently. Finland and Chile. So the high debt ratios and a high impact of a debt slowdown are what identify those countries. Malaysia is also possible, but it does have a lower level of debt. And the countries which are already zombified, already got so much that they can't get growing demand, the USA, the Euro region in general, Japan of course, and the United Kingdom, they have high debt ratios and low credit since 2008, and they're not going to get high credit until we reduce the level of private debt, which of course we're nowhere near doing as yet. So to show those countries in Asia and rank them, Hong Kong has the highest level of debt, but I've got a feeling it's mainly corporate debt, and I've got a feeling a lot of that is booked to Hong Kong, but not actually borne by Hong Kong. You can get the distinction. China, number 2, Australia, number 3, and Korea, number 4. Singapore, Malaysia and Thailand are sort of in the relatively tricky but safe zone. Indonesia stand out with an incredibly low level of debt. Of course, after their horrific crisis in 1997, they haven't gone near debt anything like the scale of the rest of the global economy. So I see them as actually probably the safest currency. Now, China's got the biggest bubble of all, of course, and when you look at it, it was a policy response by the government to the financial crisis. There was a huge exodus of workers from the seaside cities back into the countryside when the crisis hit, because of about a 40% fall in Chinese exports when the crisis began. And that drove the unemployment rate in China from 4.09% to 4.09%, if you trust the official stats. Okay? Of course, dramatic increase in unemployment, political instability. The government response was to tell the banks, half of which are state-owned and the other half no to obey the state, to lend to anybody with a pulse. And so you had a debt ratio rising from being pretty much flatlining of 1.2 times GDP up to 1.5, and now finally 2.1 times GDP. Now, the form the crisis will take in China is going to be quite different to anywhere else, but it can't avoid a crisis, and I think the data is showing it's going through one right now. Though whether you can trust, the data itself, of course, is very problematic with China. So looking at the level of credit before and after the crisis, this is the smoking gun of credit for China. Before the crisis, the average in the decade before the crisis, credit was averaging 15% of GDP. After, it's been 27%, far in excess of the rate of growth of nominal GDP. They simply can't sustain that level of growth. So it'll face a debt crisis, but the form that it takes, very, very hard to work out. They're running at the moment, as I said, about a 29% credit level of GDP. Huge. They can't sustain it. Whether they will see it in the data itself, I don't know. How they'll hide it, another question, but they are going to have a crisis.